All right, let's talk about VIX ETFs. You've probably heard of them, right? They're pitched as this really direct way to trade the market's fear gauge. But what you might not know is that underneath the surface, these things are loaded with complex mechanics and, well, structural traps that can catch even experienced traders completely off guard. So let's pull back the curtain and deconstruct them. Let's see what's really going on under the hood.
You see it on the news all the time. The VIX spikes 20% and everyone's panicking. And the first thought is, hey, I can trade that. But here's the twist, the big catch. You can't actually buy the VIX index. It's not a stock. So how in the world are people betting on volatility? Well, the answer isn't in the index you see on TV, it's in the futures market that it's all built on. So here's our game plan. We'll start with the VIX you see on the news versus what you can actually trade. Then we'll get into the term structure. This is the engine that drives everything. After that, we'll look at 3 key ETFs, show you the mathematical trap of leverage decay, and wrap it all up with a very real and very scary cautionary tale.
Okay, first up, let's tackle the most fundamental concept of all. Honestly, the difference between the VIX index and a VIX futures contract is probably the source of most trading mistakes in this space.
So, first things first, the VIX index that you see on TV, it's just a number. It's a theoretical, real-time calculation based on S&P 500 option prices. It's nothing more than a snapshot of what the market expects volatility to be over the next 30 days. You know, you can think of it like a speedometer for fear. It tells you how fast the panic is rising, but it's not a car you can actually drive. The biggest mistake people make is thinking a VIX ETF will perfectly track this number. It won't, not even close sometimes.
So if you can't trade the index, what can you trade? You can trade VIX futures. A futures contract is just a bet. It's a bet on where you think the VIX index is going to be at a specific date in the future. And this is the absolute key to everything. VIX ETFs don't hold the VIX itself. They hold a constantly shifting portfolio of these future bets. So these funds aren't tracking today's fear, they're tracking the market's guess about fear a month from now. Huge difference.
And that brings us to what is, without a doubt, the single most important concept you need to understand these products: the VIX futures term structure. This is the hidden engine, the invisible force, that determines their performance. So what is the term structure? It's actually pretty simple. It's just a lineup of all the VIX futures contracts, showing the price for next month's contract, the month after that, and so on. The shape of that line, that curve, is everything. It tells you if the ETF is fighting an uphill battle every single day, or if it has the wind at its back. A lot of the time, the shape of this curve matters way more than what the actual VIX index is doing.
Now, this structure can really only be in 2 states. The normal state, which happens about 80% of the time, is called contango. This is where future prices are higher than near-term prices, and it creates a constant headwind for long ETFs. The opposite is backwardation. You see this during a market crisis. This is where the near-term prices are way higher, creating a powerful tailwind.
This headwind is created by a process called the daily roll. See, to keep its 30-day target, the fund has to constantly sell the contract that's about to expire and buy the next one out. Now think about what happens when you're in contango. You're forced to sell the cheaper, closer contract and buy the more expensive, further one. Day in, day out. This systematic loss, this slow bleed, has a name: contango bleed. It's relentless.
So how does this all actually play out in the real world? Let's look at 3 of the most popular ETFs that traders use to play this game, and you'll see each one is designed for a completely different purpose. First, you have VIXY. Think of this as the plain vanilla straightforward long ETF. It tracks the futures index and is completely exposed to that contango drag we just talked about. Then you have UVXY, which is like VIXY on steroids. It's leveraged, aiming for 1.5 times the daily return. This amplifies everything: the gains, the losses, and that contango drag. And finally, you have SVXY, the inverse fund. It bets against volatility, trying for -1/2 the daily return. It actually profits from contango, but it carries the risk of a single-day catastrophic loss.
As if contango bleed wasn't bad enough, there's another hidden cost. This one specifically targets the leverage products, like UVXY and SVXY. It's a mathematical drag caused by the daily rebalancing, and people call it leverage decay or volatility decay. The way these funds rebalance every day creates this weird mathematical quirk, a drag that just grinds down their value in choppy markets. It sounds complicated, but a simple 2-day example makes it perfectly and painfully clear. Okay, so for our example, let's say the underlying futures index starts at a nice round value of 100. The 1.5 times leverage UVXY starts at $20, and the negative half inverse SVXY starts at $50. Simple enough.
All right, day one, volatility spikes. The index jumps 10%, from 100 up to 110. UVXY, our leveraged fund, does its job and rises 15% to $23. SVXY, the inverse fund, also does its job and falls 5% down to $47.50. So far, everything makes sense. Now day two, the index falls right back to where it started, back to 100. Now to do that from 110, it has to drop about 9.09%. UVXY's target is 1.5 times that, so it loses 13.635%, bringing its value down to $19.86. SVXY's target is negative half that drop, so it gains about 4.5%, bringing its value up to $49.66.
And here it is, the punchline. After 2 days, the underlying index is perfectly flat, a 0% return, right back where it started. But look, both the leveraged long and the inverse ETFs have lost money. That right there is volatility, decay, and action. The math of daily compounding in a market that just goes up and down creates this constant drag on value. It's exactly why these are designed as very short-term trading tools, not something you want to buy and hold.
So you've got this slow, grinding risk of decay, but there is another, much faster danger: event risk. And back in 2018, a single day in the markets gave us the perfect, and I mean absolutely brutal illustration of just how quickly these complex machines can just explode.
In early February 2018, markets were quiet. Too quiet. Then, on February 5th, this event happened that's now known as Volamageddon. The VIX short-term futures index, the one these ETFs are based on, spiked an unprecedented 96% in one day. The aftermath was immediate, and it was severe.
The result for anyone betting against volatility was catastrophic. Inverse funds lost over 90% of their value, overnight. One of the most popular products, XVIV, was wiped out so completely that the issuer just terminated it. It ceased to exist. That is tail risk. It's that small possibility of a sudden, total, and complete wipeout.
So this all leaves us with one big question, doesn't it? VIX ETFs give traders some really powerful tools, either to hedge a portfolio or just speculate on market fear. But because of contango bleed, volatility decay, and the ever-present risk of another Volamageddon, they also have these structural properties that can make them absolute traps for anyone who doesn't fully understand the complex mechanics under the hood.